My name is Erik Renander. I'm another portfolio manager at Sub-Sahara Capital. And, sorry, I should go. That should say my background in Italian. Let me tell you about my experience. I started in the financial business 13 years ago as an analyst focused on global financial services. I worked for a mutual fund company in San Francisco, and I looked at banks and insurance companies around the world. I then moved to London in 2002, where I worked for a hedge fund, and I first met Rich Walter at his firm, Walter Capital. I then moved back to San Francisco, where I worked for a hedge fund called Passport Capital, which was focused on financial services in the emerging markets. I was investing in the Middle East, in India, in Asia, and South America. We did very well, and we were the 2007 Hedge Fund of the Year, and I think the performance was about 270%. I then worked for Rich Walter as a portfolio manager at Bellman Walter Capital. And I've been working at Sub-Sahara Capital since 2013. Matt spoke to you about the growth opportunities in Africa, but I wanted to tell you a little bit about our investment process. We do very detailed analysis on companies and industries. We combine a strong local presence with analysts on the ground in Africa with the global perspective. Oh, sorry. I apologize. Thank you, Matt. Sorry. It's a slide of our investment process. So we combine the on-the-ground local analysts like Matt and Mark and Leah, combined with the global perspective of Rich and I in the U.S. and our broad network in the hedge fund industry. As Rich said, we're not an Africa ETF. We're an absolute return manager that are looking to make money every year. So when we are looking at companies, we're really looking for where we see earnings can be a lot higher than what the market is expecting on the long side. Where could industries grow much faster than people are expecting? And this comes from meeting companies, having good long discussions with them, understanding their industry, and also sometimes bringing perspective we have of what's happened in other emerging markets in other countries where we've seen things happen that maybe people in Africa haven't seen happen yet. On the short side, it's the same thing. We're looking for where we think companies are going to do a lot worse than what the market is expecting. There may be more challenges, more competition than people expect. As Rich said, we all have our own money in the fund, and we're very focused on making money and not having big losses. So risk management is very important. We don't usually use leverage. We can go up to 120%, but typically it's been less than that. We're careful about our net exposures. We don't want to be more than 50% net long or net short. We keep it diversified with 25 to 50 positions, different stocks. We don't have more than 30% in a sector. And there's a rule of no more than 10% exposure to a single stock. I should say in practice, it's usually much less than that. Rich runs our risk management, and he reviews stocks if they're down 50%. There's a discussion. Why is this happening? Do we still like it? Do we not? And then again at 30%. And just to remind you, we're investing in publicly listed stocks on regulated exchanges in Africa. And the key is we want to have, just to reiterate, diversified across countries, across sectors, and across companies. Alessandro showed this slide earlier, and to reiterate, we've averaged around 16% per annum since 2009. And I think an important thing about last year is we were up about 8% last year, and half of the returns came from shorts. We made a big adjustment in the middle of the year, saw that there was going to be weakness in the commodity sector. It was actually a sector we've been bullish on before, turned it around, and actually made money from shorting the sector So while some of the African indices were selling out or going down, we're actually keep making money. This is just a chart of our rolling 12-month correlation to the S&P and to the other emerging markets. And the highest point is about 0.6, which is not a very high correlation to the S&P or other emerging markets. And recently, it's been about 0. So we're quite different. I think that is a result of the markets we're investing in. African markets can act very differently than the other emerging markets. And also, we're doing different things. We're looking for non-consensus ideas, and we're making money on the short side. So I think a lot of people get excited about Africa, and they think it's maybe just a great place to be a long-only fund. But actually, we think it's a great place to be a long-short equity fund. As Matt discussed, there's going to be long-term growth in Africa, and we're going to benefit from that. But also, the markets are very inefficient. We count less than 5 hedge funds that are focused on Pan-Africa long-short. Most of them are just mutual funds. There's only 5 hedge funds. And just out of curiosity, I mean, as Matt discussed, there are about 1 billion people in Africa. The population is going to double. These are some of the fastest growing countries in the world. And then, I guess, how many people here, you're all investment professionals, how many people have been to Nigeria? Okay, we've got 2. 2 out of 300. Okay, anybody been to Zimbabwe? Oh, actually, it's pretty good. So, we all have heard about China. It's high growth, and I think probably 50 or 60 or 100 people here have been to China. I have, we all have. But what's interesting to us, when Rich says he focuses on inefficient markets, here you have this entire continent, 1 billion people, huge growth drivers, and yet no one's been there. And to us, that's a very good place to focus on making money. The other thing that's good about Africa, I like, is there's lots of different trends. There's 54 countries, there's different politics, there's different currencies, there's different industries. As Matt said, it's not one Africa, it's not one thing. It's a very big continent with lots of different trends. And I think having those different trends helps us as a hedge fund to make money regardless of what's going on. I thought I'd just... Does that talk about Nigeria? Yes. I just want to talk about a couple. People always wonder, they go, great, we like the long-term story, but is now a good time to invest in Africa? First of all, we're focused on making money every year, regardless of what happens. And we have the option, we have the tools to do that by being able to go long and short. But of particular interest is in Nigeria. It's 160 million people in Nigeria growing. It's going to grow to 300 million people. That's almost the size of the U.S. That stock market declined 40% last year. So, yes, there's concern about oil, but actually I see a positive that I think it'll be very good to diversify Nigeria off of oil and grow the other parts of the country, other parts of the economy. This happened in Mexico a long time ago, and Mexico used to be very oil dependent. Now it's a much more diversified economy, and it's a lot stronger. So we're looking at some of the banks in Nigeria with 20% ROEs, trading between 3 and 5 times earnings. So I'm going there in 2 weeks. We're going to do a lot of research, and we have an analyst on the ground in Nigeria. So that could be a good entry point. Africa has some world-class oil deposits and mineral deposits and platinum, iron ore, coal, and copper. The commodity sector's been very weak, and it probably will continue to be weak for a little bit longer. We actually have some shorts in that sector. But there's going to be a time where these stocks are very beaten down, people will be very negative on them, and there could be a turning point. And I think there'll be an opportunity in the future to make hundreds of percent of returns on commodity stocks in Africa. The world is still growing, and they're going to need these resources. And as Matt said, the financial services sector in Africa is very attractive. We're at very low levels of penetration of bank deposits and insurance, and yet these companies are still right now very profitable. As I said, a lot of the banks in Africa have 20% ROEs. Insurance companies are profitable, but there's still a lot of growth to come. So let me finalize by saying, why do you need sub-Saharan capital to invest in Africa? We're very excited about the growth in Africa, but let's not forget, Africa can have big ups and downs. We've had 5 years of a bull market, and let's not be surprised if there's sell-offs in the U.S. and Europe. We need to prepare for everything. We shouldn't be complacent. We're targeting, but even if there is a sell-off, or who knows what's going to happen, I just say, it could have big ups and downs. But we're targeting to make 15% a year, regardless of what happens. You heard Rich. He puts a lot of pressure on us to come up with ideas and adapt to whatever's going on. And I think what's very unique about what we're doing in Africa that you won't see from any other Africa funds you ever meet is we're very experienced at generating money from short selling. Rich and I have traded in London, Europe, San Francisco, New York. We have a lot of experience making money on the short side. And last year, half of our returns were from short selling. And you won't hear that from any other African managers. And the other thing is we're very flexible. We'll adapt to the changing trends and just focus on putting up good returns. So thank you very much for listening to our presentation.